To kick things off, we're talking about currency pairs. In the world of Forex trading, currencies don't go solo, they always trade in pairs. Now each pair is a dynamic duo of two currencies, the base currency and the quote currency. Picture a tag team, each player with a distinct role. The base currency, the first currency in the pair, is your leading actor. It represents the unit of currency you are buying or selling. On the flip side, the quote currency, the second currency in the pair, is the supporting actor. It represents the currency in which the transaction is being conducted. For instance, in the pair EUR-USD, the euro is the base currency and the US dollar is the quote currency. So, in essence, the base currency is the first currency in the pair and represents the unit of currency you are buying or selling. Let's delve deeper into base and quote currencies. The concept is straightforward. In every currency pair in Forex trading, there's a base currency and a quote currency. The base currency is the first one listed in the pair, and it's the currency you buy or sell. In essence, it's the basis for the trade. For example, in the pair EUR-USD, the euro is the base currency. That means if you're trading this pair, you're either buying or selling euros against the second currency, which is the quote currency. The quote currency, also known as the counter currency, is the second currency in the pair. It's the currency in which the transaction is being conducted. In the EUR-USD pair, the US dollar is the quote currency. So, in essence, the quote currency is what you use to buy the base currency. In our EUR-USD example, the euro is the base currency and the US dollar is the quote currency. Exchange rates determine the value of one currency in terms of another. Now, let's dive into the world of exchange rates, the heartbeat of Forex trading. An exchange rate is like a price tag. It tells you how much of one currency you need to buy another. For instance, if the EUR-USD exchange rate is 1.2, it means you need 1.2 US dollars to buy 1 euro. Sounds simple, right? But how are these rates determined? Well, exchange rates are largely dictated by the forces of supply and demand in the global marketplace. When more people want to buy a currency than sell it, the value of that currency rises. Conversely, when more people want to sell a currency than buy it, its value falls. This constant ebb and flow of supply and demand cause exchange rates to fluctuate, often multiple times within a single day. Aside from supply and demand, there are several factors that can influence exchange rates. Economic indicators play a significant role. For instance, a country with a strong economy will often have a strong currency because foreign investors need to buy that country's currency to invest there. Similarly, if a country's central bank raises interest rates, its currency often strengthens because higher interest rates offer better returns to investors, increasing demand for that currency. Geopolitical events can also cause exchange rates to swing. For example, political instability or uncertainty can weaken a country's currency as investors may see it as a riskier place to put their money. In addition, market speculation can move exchange rates. Forex traders constantly analyze economic indicators, political events, and other news to predict how exchange rates will move. If many traders believe a currency will strengthen, they may buy it, driving up its value. And there you have it, a glimpse into the dynamic world of exchange rates. Understanding exchange rates and what influences them is critical to successful Forex trading. Remember, fluctuations in exchange rates are influenced by factors such as economic indicators, interest rates, and geopolitical events. So keep an eye on the news and stay informed to navigate the Forex market effectively. Reading exchange rates might seem daunting at first, but it's straightforward. Let's unpack it. Imagine you're looking at a Forex trading platform and you see the currency pair EUR-USD with an exchange rate of 1.20. Here's how to read it. The first part, EUR, is the base currency, which in this case is the euro. The second part, USD, is the quote currency, which here is the US dollar. The exchange rate of 1.20 tells you the value of the base currency in terms of the quote currency. In simpler terms, it shows you how much of the quote currency you need to buy 1 unit of the base currency. So, if the EUR-USD exchange rate is 1.20, it means that you need 1.20 US dollars to buy 1 euro. That's it. The mystery of reading exchange rates unraveled. For instance, if the EUR-USD rate is 1.20, It means 1 euro is equivalent to 1.20 US dollars. There are two types of quotes you'll encounter, direct and indirect. Let's delve into the differences. A direct quote is when the price of one unit of foreign currency is expressed in terms of the domestic currency. For instance, if you're in the United States, a direct quote for the EUR-USD pair may look something like this. 1 euro costs 1.20 US dollars. On the flip side, an indirect quote is just the opposite. It's when the price of one unit of domestic currency is expressed in terms of the foreign currency. So, if you're in Europe, an indirect quote for the EUR-USD pair could be something like 1 US dollar is equal to 0.83 euros. It's like looking at the Forex market through two different lenses. Both quotes provide valuable information but from different perspectives. Understanding this distinction is crucial for accurate interpretation. Currency pairs are categorized into majors, minors, and exotics. Let's dive into what each of these categories means. Starting with the majors, these are the most traded currency pairs in the world and typically include the US dollar. They are called majors because they represent the world's largest economies. The 7 major pairs are the EUR-USD, USD-JPY, GBP-USD, AUD-USD, NZD-USD, USD-CAD, and USD-CHF. Moving on to minors, these pairs don't include the US dollar. They are made up of the major currencies except for the US dollar, such as the euro, the British pound, and the Japanese yen. Some examples of minor pairs are EUR-GBP, GBP-JPY, and EUR-AUD. The third category is exotic pairs. These are made up of one major currency and one currency from a small or emerging economy. Exotic pairs are less frequently traded and can be more volatile due to lower liquidity. This can make them risky, but potentially rewarding for traders who understand the markets well. Some examples of exotic pairs are USD-SEK, which pairs the US dollar with the Swedish krona, and GBP-ZAR, pairing the British pound with the South African rand. Each of these categories offers different opportunities and risks based on factors such as liquidity, volatility, and the economies they represent. Major pairs are generally more stable and have lower spreads, but may offer fewer opportunities for significant profits. Minor pairs offer more volatility and potential for larger profits, but also higher risk. Exotic pairs are the most volatile and risky, but can offer substantial profits to those who trade them wisely. In addition to these three categories, there are also cross-currency pairs. These pairs do not include the US dollar. Cross pairs can be from any two major economies, such as the euro and the British pound. These pairs offer yet another set of trading opportunities and challenges, and can be a good way to diversify your trading strategy. Exploring these pairs provides traders with more diverse trading opportunities. So understanding the differences between major, minor, and exotic pairs can help you choose the best ones for your trading goals and risk tolerance. Now, let's talk about bid and ask prices. In the world of Forex trading, these terms are fundamental. The bid price, simply put, is the price at which a trader is willing to buy a currency. It's the highest amount that the market deems the currency is worth. On the other hand, the ask price is the price at which a trader is willing to sell a currency. It's the lowest amount for which the market is ready to sell the currency. Just like in any market, the buyer wants to buy low and the seller wants to sell high. But here's the twist. In Forex trading, the seller's ask price will always be higher than the buyer's bid price. This difference, my friends, is what we call the spread. It's the cost of trading, the fee that your broker takes for facilitating the transaction. The difference between these two prices is known as the spread. And there you have it, a comprehensive guide to understanding currency pairs, base and quote currencies, and how exchange rates work in Forex trading. We've taken a deep dive into the intricacies of Forex trading, starting with the basics of currency pairs and their components. We've decoded the enigma of exchange rates and how to read them, and also differentiated between the types of quotes you will encounter. We've classified the various types of currency pairs, from the most traded majors to the more diverse minors and exotics. We've also touched upon the significance of bid and ask prices, and introduced you to the concept of cross-currency pairs. Each of these elements plays a crucial role in your journey as a Forex trader, providing you with the tools you need to navigate this exciting market. Successful trading starts with a solid understanding of these fundamental concepts. If you found this video helpful, please give it a thumbs up, subscribe to our channel, and hit the notification bell to stay updated on future content.